folks. So glad you're here. Hey, you're interested in getting the research and development tax credits. Most of you watching this probably recently got the PPP money, right? The Payroll Protection Plan, which was a loan, which was forgivable. Hey, that's great. We're going to be going over the research and development tax credits that are available to pretty much all healthcare professionals, with exception of some primary care physicians and a few others. But if you're watching this, you're probably a dentist, you're probably an orthopedic surgeon, you're probably a LASIK doctor, some doctor that specializes in certain services and uses certain tools, products, protocols, systems, and all this stuff that relates to the tax law that was passed in Congress in 1981. Us doctors didn't know about this much at all back then. It was mainly for the big businesses. And of course, I have a specialist named Jerry on the phone, and I'm going to get to him in a second, and just kind of talk about my story a little bit, how I met Jerry, and why you're even listening to this. So yes, it is true that the average practitioner has about 30,000 to 100,000 sitting there in unclaimed tax credits, not deductions, but actual tax credits that you will get to you as a check, because you can go back 3 years, federal, 4 years state, something like that. Jerry's going to give the details because he's the specialist. But we got him on the phone because, as you guys know, watching this, I work with practices all over the U.S. that are moving toward total practice freedom. That's a mixture of clinical freedom, doing the procedures you love, lifestyle freedom, going on vacation when you want to, being with the family when you want to, playing the recreational games that you want to, or fish like Jerry and I like to. You can see his 10-pound bass in the background. And then financial freedom. And we know that the biggest threat to our financial freedom is what? Taxes. So when you get good at a sport like basketball, you add new techniques. You add new ways of dribbling, new shots. When you get good at saving taxes, you add new techniques. So the featured one I'm going to talk about with Jerry, because so many doctors in my network have finally taken advantage of the research and development tax credits, which originally passed into Congress in 1981. 1995, because it was so successful, our government wanted to keep us ahead of countries like Russia and China. They signed them permanently into the tax code in 1995, and Congress passed that. Now, 2 years ago, they expanded it since the 90s, and now it is available for all small business owners, not just the 50 million and $5 billion companies. So really, really cool. And we are going to start fixing the biggest leak to your wealth, taxes. We're going to focus on the real estate and development tax credits that so many doctors and practices are taking advantage of now. But Jerry, also being a tax specialist, and literally he's worked with hundreds of accountants, specialty accounting groups, and has his favorite pick. He's going to talk about cost segregation on buildings and a bunch of other typical tax savings techniques that private practitioners, doctors, and of course that includes dentists and chiropractors and all the rest of you can employ. So Jerry, thank you for being here.
Hey, thank you, Brady. Thank you for having me.
Hey, this is great. I know your story, but tell these people why you're so passionate about working with small businesses, particularly in healthcare. And, you know, I've had many of my docs and my big study club who are seeking total practice freedom work with you. Those watching this probably are not in that group, because we're pushing this out and help more people. What's your story? I mean, you built a big company and you didn't get these tax credits, and now you want everyone to have access. So tell me your story, Jerry.
You know, every time you tell me how much money I lost on that, I'm not knowing these tax credits, I get PTSD. You know that when I start rubbing my head, that means I've got PTSD. So the Reader's Digest version is about 16 years ago, I took an idea out of my head and I created a global brand, a global company. I have 24 patents in 14 countries. My clients are small companies you might have heard of, Marvel, Disney, Home Depot, Lowe's, Amazon, Academy Sports and Outdoors, Dick's, Scheels, Dunham's, Snap-on, Matco, Cornwell, Lowe's, Home Depot, Sears, Craftsman, Hilti. I mean, I can go on and on for weeks. So spent 16 years of my life traveling all over the country, building all over the world, actually building that company, from manufacturing to sourcing. almost killed me. Decided I was going to sell it, sold out. The private equity company that bought me had bought the entity, and the entity continued to operate, and they bought the assets and liabilities. And about 8 months later, I get a check in the mail from the IRS into my name for $757,047.13. Now I know, to a lot of you doctors out there, that's not a lot of money, but to me and a little old, country boy like me, that's a ton of money. So I called my CPA up that I'd had for 20 years. And I says, hey, Jim, got a question for you. I got this check in the mail from the IRS. Do you know anything about it? He's like, nope. I said, well, I'm going to cash this bad boy. And he's like, Jerry, you sold your company. You might ought to call a PE company that bought you and, see if they know anything about it. I'm like, yeah, okay. So I called Tim, which is the private equity company, the owner. And he said, I said, Tim, I got this check in the mail from the IRS. I just wanted to touch base with you before I cashed it. What's your thoughts? He's like, is it over 700 grand? I'm like, yeah. He said, yep, that's our money, send it to us. And I'm like, whoa. Time out. It has my name on it. He's like, well, Mr. Wright, your company was a pass-through entity. We purchased your assets and your liabilities. The entity is still in operation. So we noticed going through your tax returns that you had never filed for federal and state tax incentives. Okay. He's like, well, we filed on behalf of the company because the company is what qualified. And that's how much money you essentially overpay your taxes. So because you have a contractual liability to us, you have to send us that money. Now, here's the PTSD, right? So I realized, I have a contract, so I had to send them the money. And I sent them the money, and as soon as I sent them the money, I called my CPA up and I said, hey, Jim, you've been my CPA for 20 years, and I love you. You saved me a ton of money. You're a great CPA. But remember that check I was telling you about? He's like, yeah. I said, well, have you ever heard of these federal and state tax incentives? Yep. Did you ever file for them on behalf of the company? No. Why not? Well, Jerry, I do taxes. I don't do tax incentives. I was like, well, Jim, that check was for over 700 grand. He's like, wow, that's a lot of money. I says, Jim, do the math. I owned that company for 16 years. So that they went back 3 years, 700 grand, do the math. I left about $4 million on the table in overpaid taxes. He's like, wow, that's a lot of money, Jerry. And I said, Jim, if you were still my CPA, I'd fire your beep, because I was pretty upset, right? So he said, well, Jerry, I'll tell you right now, you'd fire pretty much all of the CPAs, 99% of the CPAs in America, because that's not what we go to school for. We go to school for taxes. And I'm like, well, Jim, why didn't you tell me about it? He's like, Jerry, I just told you, we do taxes. We don't do tax incentives. Well, why doesn't somebody tell us about it? Us being small businesses. He said, I don't know. Great question. So I called IRS. IRS says, yeah, we have them, plenty of them. It's public information. They're on our website. Okay. Call the state of Texas, Arkansas, Louisiana, Oklahoma, Florida, Virginia, Washington, Oregon, California. Call almost all of the states. And they said, yeah, we have them, and it's on our website. It's public information. And I was like, okay, well, why aren't you guys sending out a notice? He was like, it's on our website. It's public information. So what I realized was at that moment was the government has created a level playing field, but knowledge is the key. And most business owners, one, think their CPAs are tax gods and they do everything. And I learned by losing $4 million, my CPA was one of those that's not a tax god. They do taxes and that's it. The other thing I learned was that, and this is what put a fire in my belly, as we say here in Texas, is that I realized that you can only go back, I've learned through my research, you can only go back 3 years federal and 4 years in state. Okay, well, I own my business for 16 years, so what about the other 13 years that I overpaid my taxes? Well, that's money that the government keeps. And here's what really just chapped me off. That's the money that the government keeps to give to the Amazons of the world to not pay taxes. How does an $11 billion a year company not pay federal taxes? Not just 1 year, but since they started up until last year, they've never paid federal taxes. How much money have you paid in federal taxes? How do you, Mr. Doctor, Mr. Professional, how do you pay more taxes than the Amazons and Disney and Netflix of the world? It's because they have teams of CPAs, Ernst & Young's, Deloitte & Touche's of the world. They scour the tax code looking for these incentives to find them for it so that way they can apply. So last year alone, there was over $25 billion given out in federal in tax incentives, and 89% of that $25 billion went to the largest companies in America for one reason and one reason only, because they showed up. They actually applied. So what I learned was that in essence, because you can tell I'm a big fisherman, small fish like me were feeding the big fish so the big fish could get big enough to eat the small fish. And that's what really made me mad, was that how many of you out there were like me? You thought your CPA did this, and you've overpaid your taxes for 2 years, 5 years, 10 years, a decade. How much money have you lost, and how much money could that have helped you build your business and create generational wealth? And that's really what it's about. We pay more in taxes as professionals than large companies, and that's not fair. So I started my company to educate, identify, qualify, quantify, and help professional doctors take advantage, apply for these federal and state tax incentives. And it's really not that hard. It takes about 2 hours of your time. And I've helped, like you mentioned, some of your clients, some of my clients, 35,000, 74,000, 185,000, 625,000. There is serious money out there the government's willing to give you if you qualify. So is it worth 2 hours of your time to see if you qualify? I don't know. I mean, a couple $100,000 isn't a lot of money to you, then let me go ahead and give you my PayPal account number, and you can just wire that over to me. But I don't know of anybody. I mean, we've helped hundreds. Well, I'll put it this way. Over the last 12 months, we've helped clients recover over $88 million in federal and state tax incentives.
I love it, Jerry. And you're right. I have a large study group of doctors all around the U.S. who are in the process of achieving or have achieved total practice freedom, which includes financial freedom. And a big part of that is not only increasing revenue, decreasing overhead, adding vertical streams of income or more profit centers, but now retaining more of that money by plugging the biggest leak to your income, the tax leak.
Yep.
And, you know, many doctors watching this right now, hey, they're getting a lot of deductions, right? But we want to open your eyes to the tax credits, the incentives, which is money right in your pocket, actual checks. So Gary, by the way, for those of you getting antsy and you're like, okay, I want to do this now, go ahead and put your email or your contact somewhere in here. That'll get you to the next page, which will give you a link to get on the phone right away with Jerry or one of Jerry's team and my team that will basically give you the forms, okay? And of course, if you have more questions, you can ask more questions before that point. We'll go at your pace, but there are a lot of other tax savings vehicles, aren't there, Jerry, to the average doctor out there seeking total practice freedom. Tell me about some of the other ones you've done for the doctors in my study group around the U.S. that are achieving total freedom and others. So tell me about those.
One of those, I mean, there's over 70, I want to tell your listeners to understand, your doctors to understand, there are over 70 federal and state tax incentives available to businesses. You're a business. So you have cost segregation. Well, the previous cost segregation law says that you can buy a building and you can depreciate that over the next 30 years. Well, I tell you right now, I don't want to wait 30 years to get my money back in depreciation value for my building. So the recent tax laws changed that to where you can now accelerate that depreciation over the course of 5 years. So would you rather wait 25 years for your depreciation or get your money back in 5 years? That's one. Another one is this WOTC, Workers' Opportunity Tax Credit. And that's, I mean, very few people have heard of this one, but it's called Workers' Opportunity Tax Credit, WOTC. And what that is that there are a plethora of qualifications for future employees that you may hire. If an employee that you're looking to hire, it falls into one of those qualifications, then and you hire them, then the government will pay you up to $9,600 per employee for every qualified WOTC employee you hire. So I have one dental practice that they hired 15 employees, and that's about how much they average a year because they're going like crazy. But out of those 15, 10 of them were WOTC qualified. So he got $96,000 for hiring these employees. That's tax-free money. The other one is that, I'm sorry, go ahead. You had a question.
So with WOTC, just to be clear, folks, we're on number 3 tax incentive, and I've told him of the 70 incentives or credits available to go over the top 5. So number 1, what Jerry calls low-hanging fruit. That's the research and development tax credit. Some of the folks that are working with our medical device company or our clear aligner company or are in the orthopedic sector, or are testing certain products, or are a faculty with an institute. Jerry works with a lot of our institutes that teach other doctors around the US. That is really low-hanging fruit, because you are literally, once you answer about 20 or so questions that Jerry and his team of 20 specialists give you, you'll see immediately, oh, and I have qualified all these years, and especially now if you're doing a lot of those activities, and you're going to have a PTSD moment like Jerry, you will realize you may have lost more money than you have in your retirement account right now.
Exactly.
Whoa.
Exactly.
Whoa.
Yep.
Okay. So that's number one, R and D. That's quick money, easy money. And hey, like Jerry said, the multi-billions, tens of billions that corporations are receiving is dwarfed by the 2 or 3 or 4 billion that smaller businesses are getting. It's actually about 8 or 9 billion. So number one, research and development tax credits. I'm going to say that's the first one you should get. And once again, if you're running out of time, just put your email in. You won't lose us. We're here. I've been around doing this for 2 decades with buying and selling practices and working with doctors. Jerry's been in business for decades as well. We're not going anywhere. You can pick this video up later, or get shoot your email in there for a deeper level PDF on all of it, and then a phone call with any of us. We want to help you. Number 2, cost segregation. If you own any real estate, and many of you doctors, dentists, chiropractors, vets watching this do, then what we can do is, instead of you depreciating what you've already paid for, either with your debt or your down payment over 24 years or whatever, you can now, boom, depreciate that in 5 years, which means the last 3 years of your tax returns, you've overpaid once again. So there are a bunch of ways to do that. So cost segregation on real estate is a biggie. Then WOTC. WOTC is another one. It's kind of like PPP, but it's not a loan, a forgivable loan, and it relates more to employees. PPP is the payroll protection plan, right? Helping out employers of employees, basically help these small businesses get money. That's what PPP was. And WOTC, right? $9,600 per employee if you qualify. And he was talking about specifically a dental practice that just got 96 grand in their pocket. So that is number 2, 3. So that's number 3, Jerry. Love it. Keep going. I'm just outlining for folks.
I'll give you some highlights, some other ones. Well, not every, but there are federal empowerment zones across the country. Nobody knows about those. If you're located in that federal empowerment zone, more tax credits. Local federal or local empowerment zones, state empowerment zones. We do property tax mitigation, which your property taxes keep going up, right? So we help you mitigate those taxes. There's the energy tax savings. There's 45L and 179. If you've made any energy improvements to your buildings, there's additional tax incentives. So like I said, there's over 70 federal and state tax incentives available to you. And I'm going to tell you right now, I talk to hundreds of CPAs every month. And the conversation always goes the same way. I'm going to tell you right now, these CPAs that do your taxes, they do taxes. I want to make myself perfectly clear. We do not do taxes. We don't scrutinize your CPA's work. That's not what we do. We don't care what he did, because he's reliable. He's liable for his own work. We don't care what he did. That's his responsibility. That's his fiduciary duty. We have our own fiduciary duty. All we do is we extract the numbers. They're called QREs, Qualified Research Activities, and the other information that our CPAs need to plug into our system for your particular tax incentives that you're applying for. That's the numbers we need. We're not going to try to take you away from the client. We don't care. I mean, from your CPA, we don't care what he does.
I'm going to give you a story now, Jerry. Can I give you a story real quick? And then I'm going to end it and let people get to the next step of getting access to this. I saw one of the docs that I've been helping grow into multiple locations. He just netted over $250,000 last month, has been doing great. And now he said, Brady, you know what? I'll tell you what, I worked with Jerry and his team and recovered about $35,000 right off the bat. And he said, I'm going to recover hundreds of thousands with just the first one of these. And then beyond that, even more. So he went ahead, did that. He used that money to buy another location, a second location, use that right back. And so for those of you that are watching right now, and you're like, hey, is this going to trigger an audit? No, it doesn't. There's 2 ways of doing it. if you do what they recommended in 1981, it was a lengthy process. This one, you just claim it, just like PPP. Did PPP trigger an audit? Absolutely not. So this is super easy. It's already, that's why in 1995, they made the alternative simplified reporting method. Yep.
Yep.
And let me have you speak to that in just a second. Like, oh, am I audited doing this? But I talked to my accountant about it because I was like, hey, what do you think? So Jeremy's his name. He's super conservative. He said, yeah, they've been out there all the time. In fact, we've had a lot of specialty accounting firms and specialists like Jerry that have done that for our clients, and it works great. Once again, I said, why didn't you tell me? It's because if you're a doctor right now and you're a specialist, that's why we have specialists in medicine and dentistry and the healthcare fields. Jerry and his team of 20 specialists around the US do that, and then they give that to your account. You don't need to switch accounts. So speak on that. Like, oh, are you at a higher risk of an audit?
Yeah, like I said before, previously I spent 16 years building a global brand, and I got audited 3 times. And let me tell you, as a business owner, that's your worst nightmare. And audits come in a lot of different fashions, but at the end of the day, nobody wants to get that letter. So the reason why there's 2 different accounting methods, actually there's 3, but the 2 main ones that are used by our competitors are called, one of them is called the contemporaneous accounting method. Developed in 1981, I equate it to the 1040 long form because your accountant or the person working on your case had to go into your business, spend 2 or 3 months extracting all this information, documenting all this stuff, very intrusive process, filling out a long form, and then sending it into the government. So the government, using the contemporaneous accounting method, and here's what our competitors and people aren't telling business owners. If you use the contemporaneous accounting method, you are stuck with that method for 3 years. You cannot switch back and forth, number 1. Number 2, the first time you use the contemporaneous accounting method, it is going to trigger an audit, guaranteed, because the IRS has to establish or quantify or substantiate the information that you're sending them so they can establish a base amount for your business, okay? So that was started in 1981. A lot of companies similar to mine do that, use the accounting method. Fast forward to 2006, the IRS stepped back and said, wait a minute, we've been collecting all this information since 1981, 35 years. We already know who qualifies, how they qualify, the supplies, their employees. We already know all this stuff. So we're going to create a new accounting method called the Alternative Simplified Credit Method. Let me say this right here. If you don't believe me, Google it. Alternative Simplified Credit Method. What that does, that allows businesses to qualify and recover these tax incentives using a very short, simplified accounting method. And what it is that, like I said, the IRS already knows all this information. So the accounting, the ASC method, I equate it to the 1040 easy form. It's a one-pager, right? The difference is that the contemporaneous method is going to allow you to claim every single penny that you have, that you've applied for and that you qualify for. But they establish that base amount for your business. The ASC, the IRS said, you know what, we're just going to give a standard industrial code, the entire listing, a percentage. So you might not recover every penny using the contemporaneous accounting method. You might recover maybe 3% less. But that 3% is sure worth your time, your energy, your effort, because you don't want people like me or the IRS coming up all up in your business for 2 or 3 months extracting all this information out. So the beautiful thing about what we do is we use the Alternative Simplified Credit Method. Very non-intrusive. We've never, out of the thousands of clients that we've helped, not one's ever been an audit, because whenever we do this, an IRS agent looks at this and goes, okay, they're applying for the R&D tax incentive. They didn't change the formation of the company. They didn't change the address. They didn't change the ownership. What did they change? Oh, they're applying for the Alternative or the R&D research tax incentives. Here's the documentation, our documentation showing how they qualify, and that they use the Alternative Simplified Credit Method. Perfect. They plug in the numbers. Here's the percentage. Yep, it matches. Here's your money. It literally goes just like that. And if you don't believe me, I'm more than happy to set up phone calls with some of our clients, because they're going to tell you the same thing. It works. It works. Well, it's true. It works. It's like money.
I love it. So that was the thing that I was worried about most. Like, oh, okay, does this trigger an audit? And you're right. Out of the 86 million that you've gotten for folks, not one audit. So let's do this, Jerry. We've given people enough information to either decide if they want to take advantage of what the government's given in tax credits or not. So here's my last message to folks. Go ahead and put in your email. It might ask for a phone number as well. Click that. it's going to go to the other side, another page where Jerry and I are going to talk about the next steps you'd actually take to do this. Because once again, the important part is you don't just get to claim these this year. You go back 3 years, and that's when the IRS sends you checks. So right now, plug in your email address. You've really got nothing to lose except losing a bunch of money that you haven't claimed, right? So far, like myself, I just sold my medical device company 2.5 years ago to private equity, Jerry. Your number was 4 million. My number was close to $2 million in lost tax credit stuff. So, hey, for you guys, even if you save hundreds of thousands of dollars, what would you do with hundreds of thousands? Would you buy a vacation home? Would you beef up your retirement account? Would you go ahead and go on family vacations every year paid for the next 2 decades? What would you do with it? Would you pay for kids' college education? What would you do? So there's a lot of stuff you can do with that money that's sitting there. Go ahead and plug in your email. You'll see Jerry and I on the other side of that email going over the 3 steps to get access to Jerry's team and start the process right away. We'll see you on the other side.
Bye.